Hello and welcome to another accounting tutorial. Within this video we'll be covering the topic of accruals and more specifically accrued income. But firstly, if you could hit the like button, subscribe to the channel and click the bell icon, it would be hugely appreciated. I'll be bringing regular content to the channel to try and help you further your accounting knowledge and hopefully help with your exam preparation. So the aim of this session is to introduce you to the accruals concept. What is it and how do we record them within our accounts? If you've seen the accrued expenses video, you'll already be familiar with the concept, but we'll do a quick recap anyway. The accruals concept in itself is quite straightforward. We're making sure as a business that we're matching the revenue or expenditure with the correct period. So unlike cash accounting, where we record the transaction when the money is physically paid or received, in accruals accounting we're recording the transaction when the goods or services were acquired or took place. Now let's have a look at accrued income in more detail. The accrual of income occurs when the business has sold goods or performed services before the end of the period, but hasn't yet invoiced the customer, and therefore there is no record of this in our accounts. Take a look at the example on screen. This business is invoiced for rent for £1,000 per month from January through to November. Their financial year runs from January through to the end of December, and at the end of December, they haven't yet prepared the invoice for the month's rent. Now, when preparing the accounts, they would need to accrue, that is to add in the December amount, because the customer has had the service. In this case, they've occupied the building for the period of December. So just because the business hasn't raised the invoice doesn't mean that they leave it out of the accounts, because in theory, the overall income figure wouldn't be realistic, as the rental income for December would have been left out. Within the final accounts, accrued income is added to the income account, therefore increasing the value on the account. They're then shown as a current asset in the year-end statement of financial position. This is to represent the amount owed to us and yet to be received. The reason for dealing with accruals in this way is to ensure that the profit or loss records the income that has been earned for the year instead of simply the amount that has been received. In other words, the income is adjusted to relate to the time period covered by the profit or loss. The statement of financial position shows an asset for the amount that is due to the business. The double entry, therefore, to record an accrued income is to credit the relevant income account, increasing the balance, and debit the accrued income account to increase the business's assets. Now let's put this into an example scenario. Here we have our first case study. The trial balance of Hawkins Limited at the 31st of December 2021 shows a credit balance for the commission received of £6,200. Before preparing the financial statements, the accounts team have been informed that there is an outstanding commission received to be invoiced to the value of £900. Therefore, an adjustment needs to be made in the financial statements for 2021 to record this additional income. Firstly, let's have a look at our accounts before any adjustments were made. We can see that there's currently a balance of £6,200 within the commission received account. There is also a nil balance within the accrued income account. The next step is to record the accrued income within our accounts. To do this, we credit the commission received by the accrual amount of £900 and debit the accrued income for £900. At this point, we've successfully entered the accrual within our accounts. We now need to look at closing off these accounts as part of the year-end process. To do this, we transfer the balance on the commission received to the profit or loss. In this example, that would be the current balance of £6,200 plus the accrued income of £900 to give you £7,100. We then debit this to the commission received account and credit the profit or loss. Within the accrued income, we simply need to balance off the account, which will then be brought down into the next period. So how will this look in the new financial year? At the start of the next financial year, the accrual is reversed. The effect of this is that we have a nil balance on our accrued income account and a £900 debit balance on our commission received. So at this point, our accrued income account is nicely tied off, and we no longer have anything to do on this. The final step is to look at what happens to our commission received account and examine why we have a debit balance of £900 on there. Now let's say, for example, that on the 8th of January 2022, so at the start of the new year, the invoice is raised and paid by bank transfer. Now we record this as a credit in the commission received account and a debit to the bank. You can see that the effect of this is that we end up with a nil balance on our commission received account within the new year. This is exactly what we want because the £900 invoice related to our previous year, and therefore we don't want this showing as income on the profit or loss in 2022. Right, so that does cover our first case study. I am going to go over a second one as well. It is similar to the first, but rather than it being for the final month, we'll be calculating a quarterly amount. So case study 2. Munda Difflin is a business selling paper, but as a secondary income stream, they also rent out their warehouse to a distribution company. Their financial year runs to the 31st of March 2021. The rental income shows a credit balance of £24,000, which represents the first 3 quarters of the year. They are yet to invoice the last quarter of 2021. What is the amount of the accrual and how is this dealt with in the accounts? Firstly, we need to calculate the amount to be accrued. The balance for £24,000 represents the first 3 quarters of the financial year. So if we divide this by 3, we get the quarterly amount of rent that's being charged. Therefore, £24,000 divided by 3 gives us a quarterly amount of £8,000. The business therefore needs to include £8,000 in their rental income account for the year ending the 31st of March 2021. Let's have a look at how we record this. Let's firstly just look at the accounts before there's anything entered. So we have a balance on the rental income account of £24,000 and a nil balance on the accrued income. The first step will be as we did before, which is to record the accrual within these accounts. To do this, we credit the rental income for £8,000, therefore increasing the amount on the income account, and debit the accrued income account, increasing the business's assets. Now the next step will be again to close off the accounts at year end. To do this, we will transfer the balance on the rental income account to the profit or loss. So the £24,000 plus the accrual of £8,000 equals £32,000. We then balance off the accrued income account by showing the balance carried down, which will then be brought down in the new financial year. So finally, at the start of the next financial year, the accrual is reversed. To do this, we debit the rental income account for £8,000 and credit the accrued income for £8,000. The effect of this is that we have a nil balance on our accrued income account and an £8,000 debit balance on our rental income account. So at this point, our accrued income account is tied off. There's nothing more that we need to do on this. Then within the rental income, we can expect the £8,000 to be invoiced and paid sometime around the start of the new financial year. This would then be recorded as a credit in the rental income account, which would offset against the £8,000 debit balance already in there. The final part that I'd like to show you here is just how this would look in an extended trial balance. So using case study 2, we can see that the rental income has an existing balance of £24,000. We then enter the accrual within the adjustments column to show the increase to the rental income account. And we then enter it within the debit side of the adjustments column to show the accrual amount. The existing balance plus the adjustment is then transferred to the profit or loss. And the accrued income is shown as an asset within the statement of financial position. So that wraps up the video. I really hope you found the information here useful, and again, if you could hit that like button and subscribe to the channel, I would be very grateful. Thank you very much for watching, and I'll see you in the next video.